Welcome to today's webinar. My name is Joseph Jansen. I'm cultural economics at Montana State University. What I'm going to talk to you today is a little bit about crop rotation planning. And in particular, given that we're sort of thinking about the crop rotations in Montana, we're going to talk a little bit about pulse crops and how they might fit into those rotations. So to begin, we're just sort of defining what are pulse crops. So really, we're going to talk about three major crops that we grow here in Montana that be classified as pulses. So those are chickpeas, lentils, and dry peas. Inside each of those crops is a whole host of different varieties, and each of those have specific markets and end uses. We won't spend a whole lot of time sort of thinking about what's the difference between a green or a red lentil, or whether you should be growing green peas or yellow peas. There's just to say that there's a wide range of products. All of those fall under pulses, and they all sort of have play potentially a similar role in crop rotations that we might want to adopt. Hello, hello, hello. Huh. Joel, can you hear me now? Okay, how does that sound? Okay. I just disconnected and reconnected the mic, so we'll just assume that was good. Okay, we're going to go back to the beginning. At least this first slide will now be very well rehearsed. Okay. Welcome to today's webinar. My name is Joseph Jansen. I'm an assistant professor of agricultural economics here at Montana State University. I'm going to talk to you today about the economics of crop rotation. And given that we're looking at crop rotation in a Montana context, we're going to focus specifically on pulse crops and how they might fit into crop rotations that growers might use here in our state, and particularly think about the relative profitability of different crop rotation options and how we might think about that, and how you can adapt some tools to your specific context to help you choose the most successful and profitable crop rotation for your operation. So just before we get started, we're going to think about what are pulse crops. Pulse crops are a term that we use to capture a whole bunch of different things that we might grow here in our state. So when we're thinking about Montana specifically, the pulse crops that we're thinking about are chickpeas, also known as garbanzo beans, lentils, and dry peas. And inside each of those crops is a whole number of different varieties that growers that growers can grow that have specific end uses and specific markets. So we won't talk too much about sort of whether you should be growing green or red lentils or yellow or green peas. But we do want to think about how do these crops fit into rotations? What are the benefits and costs of including them in a rotation? And in that sense, there are some similarities in terms of how they alter the profitability of the farm. And so we'll talk about that going forward. What I want to do today is first just sort of review what I think growers should know about pulse crops, both in terms of sort of how do they fit into, does the US and Montana fit into the world of pulse crop production? Where do our pulse crops grow? And then what sort of pricing do we see for pulse crops? There are two sort of unique things about pulses that I want to highlight because I think they're really important. That is the marketing contracts that are available for pulses and the crop insurance options that are available. And those affect how pulse crops fit into the crop rotations that we might want to use. So then I want to go into discussing how to plan crop rotations, and in particular, compare crop rotations that do or don't include pulse crops. And to do that, we're going to use a tool called enterprise budget analysis. So we're just going to think about essentially what is the profitability of each of these different crops, and then what is their profitability if we grow them together in a given crop rotation. And so how can we take some existing estimates of profitability, some existing crop budgets, and account for the benefits and costs of growing these crops in a particular rotation? So if you get nothing else out of this, I hope you understand that when we're thinking about profitability, it's not that we can't sort of simplify this down into, is one crop more profitable than the other? There are some complementarities that exist between different crops, and we want to account for those in thinking about whether we're going to allocate acres to one crop or another. So, pulse crop production, how big is it? Where does it fit? On the left side of this figure, I've shown corn and wheat production over the last 40, 45 years or so. And we can see that as world population has grown, right, the production of major food crops has gone up. So these lines are sort of upward sloping. And today we grow about, for example, about 700 million metric tons of wheat worldwide. And about 10% or so of that is grown in the United States. The US is growing about 30 to 40% of the world's corn. So one, for our major crops, we're a major producer, and production is large. For pulse crops, things are a little bit different. You can see that the y-axis on these graphs is totally different. Whereas we're growing hundreds of millions of metric tons of corn and wheat, we're growing only about, between 2 and 15 million metric tons in any given year for pulse crops. We've seen pulse crop production in the world go up, especially for lentils, and over here for chickpeas. Pulse crop production has increased slightly over this period for peas, but there is sort of a noticeable decline between about 1990 and today, and that's due in large part to the fact that feed use for peas is much lower, especially in Europe. So Europe used to use a lot of peas as animal feed. They don't do that anymore. But nonetheless, we've seen an uptick in growth, at least over the last decade, for dry peas as well. Thing to note here, right, is that pulse crop markets are just a lot smaller than the markets for our other major grains, right? And so if we're thinking about how does this affect the market opportunities that are available to growers, well, sometimes it's just a little bit harder. There's just less information. There are fewer buyers, and so it can take longer for sort of market developments to occur in pulse markets relative to markets for wheat that we might be familiar with. Here's the story in Montana. This is just production. This is just U.S. and Montana production. So how big is production in the United States? And then what share is Montana of that production? We can see that Montana is a substantial share, whether we're talking about chickpeas, lentils, or dry peas. Really, starting in the early 2000s, we were really a negligible pulse crop producer, and that story has totally changed over time. To the point where we're producing about half of U.S. pulses here in the state of Montana. 2016 was a banner year for U.S. pulse crop production. We had record acreage. And that's shown by the spike near the end of each of these series. So in 2016 here, We had record chickpea production, record lentil production, record pea production, both in the US and Montana. 2017, we've seen significant declines, and that's that's shown here. And a large part that's due to the drought that we experienced in our state. So we still planted about the same amount of pulse acres, but production was lower because we had particularly poor weather. Where is that acreage coming from? Well, a significant portion of that is coming from fallow. So over this period, Montana summer fallow acres dropped by about half. So from about 4 million acres to about 2. And so a lot of that allowed farmers to adopt more diverse crop rotations that included continuous cropping, that is growing a crop every year, eliminating fallow from that rotation entirely. And a lot of that was allocated to these 3 crops: chickpeas, lentils, and dry peas. Where does this stuff go? Well, the reality is that we're exporting a significant percentage. The majority of it is going outside of the United States. And India is our most important customer. So this graph shows just the share of dry peas and lentils that we send outside of the US every year, what share of that goes to particular countries. And we can see that this blue section over here, so about over a third of both our lentils and dry peas are going to South Asia, and that most of that is India. So what happens in India is crucially important for the prices that farmers receive. Whereas our wheat exports go to a lot of different countries, our pulse exports are concentrated in a smaller number of countries, and because of that, stuff that happens in that particular country has a bigger influence on price. So in India, there are a whole host of things that can sort of shock that market. So the Indian government is very active in both limiting or controlling trade. So we've had a number of potential import bans put on by India that would sort of reduce demand for US pulses. India's also used production incentives for its own growers to try and encourage domestic production. And again, that could be a negative for US growers. And finally, the Indian government maintains large stockpiles of pulses. And so when they sell out of that stockpile, that can also lower market prices. So it's something to be aware of, that what happens there has a big influence on price. The other thing to note is that food aid, that is pulse crops purchased by the US government and donated for humanitarian assistance in developing countries, is really important, especially in the last few years for yellow peas. And particularly for lower quality peas that maybe can't find a home in some of our higher quality market destinations. So this red bar shows the share of these crops going to sub-Saharan Africa. And especially for dry peas, our second most important export customer is sub-Saharan Africa. And a lot of that is that food aid market. Looking more closely to home, who's buying these things? Well, there are a limited but growing number of elevators and processors buying pulse crops. This is just a map of delivery locations in the state that accept pulse crops, put together by the Department of Transportation. Most of these locations are located on major rail lines. And a lot of these are sort of the typical buyers of other crops. So big buyers like CHS and Columbia Grain are some of the some of these delivery points. Others are pulse-specific companies that really specialize in buying pulse crops. And as a pulse crop seller, it's important to look around at all market options, both in and out of the state. So we've had a growing number of delivery locations here in the state, but a lot of growers are still shipping pulses up to Canada or east to North Dakota, where there are additional buyers and potentially additional market opportunities. Um, and so just because post-crop markets are smaller and there's less information, it really behooves growers to go out and find the best bid for their pulses um, on an ongoing basis. Try and get as much information as you can about price and about prices at different buyers. So what's been happening to prices? Well, this is sort of what's been happening to wheat prices. We can see generally over the last few years, since 2015, when we harvested our 2015 crop, prices were trending down. We had a big jump in prices in the summer of 2017, but that jump is largely ending. And that jump was much stronger for spring wheat here, this jump here in the middle blue line, than the dark blue line here for winter wheat. So if we're thinking about, well, a wheat fallow rotation hasn't looked particularly attractive over the last few years, and that's due in large part to what's been happening to post-crop prices. So particularly in any given year, it seems like one of these pulses just has a tremendously bullish price picture. We have really high prices. So in 2015 and 2016, that was lentils, the yellow line in this graph. We reached record lentil prices. That price dropped off as we had our 2016 harvest. We saw a little bit of a post-harvest rally in lentil prices going through 2016 and 2017. And lentil prices have come down, but they're still at relatively high levels historically. So in that 25 to 30 cents per pound range. And that's a pretty good price in historic terms. But even as lentils have cooled off, chickpeas heated up. And now we've seen record chickpea prices over the last year or so and persisting through this current harvest period. And so just given that we're sort of at relatively high prices, and a lot of that's driven by demand, there seems to be growing demand for these crops, both inside and outside the US. Given that pulses have looked relatively good in rotation. Putting post crops in their crop rotation, what are some useful things that they need to know before they do that? Well, I'd highlight two things. Obviously, there's a whole host of agronomic considerations. Just sort of what do you need to know about putting this crop in the ground, undergoing crop protection, what sort of herbicides, fungicides do you need to grow a high yielding, high quality crop of peas, lentils, or chickpeas? I won't focus on those. I'll focus more on sort of the economic considerations. And one of the key ones is that, and key unique things about pulse crops is that contracting for pulses is a little bit different in that a lot of delivery contracts have what's called an act of God clause attached to them. So if a grower is setting up a forward contract with a buyer, say in the spring you're planning on planting lentils, you go to your buyer and you say, what kind of prices are you offering? And you agree to deliver your pulses to that particular buyer at harvest time. One of the things that's often attached to that contract is this act of God clause. And so the grower is going to agree to deliver a specific quantity and quality at a specific time. So say a #1 medium green lentil delivered at harvest time, say in August. And they're going to receive a set price. So if prices fall at harvest time, if the cash price falls, the grower is going to still receive that price that they agreed to with the buyer in spring. But if they have a bad weather year, like the drought that we had here in 2017, they can opt not to deliver. If they don't have the bushels, they don't have to deliver, and they don't have to sort of potentially buy their way out of that contract. They just get they get the option to opt out. Okay. The buyer because they're giving the grower this act of God clause, often retains the option to purchase the remainder of the grower's uncontracted production. So the grower will contract to deliver so many bushels per acre, and then whatever's grown on top of that, the buyer often retains the option to purchase that, say at the cash price that prevails. So because there's some of these unique contract provisions, it's really important to read and understand and talk about that contract with that buyer and understand all of the provisions before you sign anything. There's some unique things that can occur. Some of those things are good. They're protections for you as a grower, particularly that act of God clause. But some of those things are options that you're granting to the buyer. And so you think about there's sort of a risk sharing that occurs in these contracts. The grower receives a fixed price, so they receive this price guarantee that if prices fall, they'll get paid that specific price, and they get that option to opt out if one of those act of God events occurs. Okay, and those events are often named in the contract, so it's important to know which events are covered and which events aren't. But the buyer receives the right for you to deliver, and often the grower's surplus production. And so you might be sort of thinking that if you're in exchange for this act of God clause, you might be receiving a discount relative to the price that is expected to prevail at harvest time. And so you've got to evaluate those trade-offs as you think about putting pulse crops into your rotation. Other thing that's important to think about is understanding some of the risk management tools. In particular, right, we know that crop insurance is some of the most important government-backed risk management tools that exist in production agriculture today. There are also marketing loans that are available, which act as sort of a price floor. But because post-crop prices are relatively strong, those current marketing loan rates are low relative to market prices, and the marketing loan program isn't really seen as a significant support for post-crop production. What is a bigger support are production and revenue insurance. And so these are very similar to the yield protection and revenue protection policies that are available for wheat and other major crops here in our state. A harvest price exclusion, where the grower can receive the higher of the springtime price or the harvest price, is available for pulse crops, just like it is for wheat. The price setting process is a little bit different because there's no futures market, no central market for peas, lentils, or chickpeas. So that's in large part based on transaction data that's collected by the risk management agency and crop insurance companies to help set that harvest price and that springtime price. But it's not done in a public futures market the way it is for other crops. The other big thing to note, and this is going to come in as important later, is that there are significant restrictions on the frequency with which pulse crops can be grown in a rotation and still be covered under these crop insurance programs. Generally, this is 1 in 3 years for peas and lentils. So on a given field, you're only eligible to purchase insurance if you haven't planted peas on that, you're only eligible to purchase insurance for peas on that field if you haven't planted peas in the last 2 years, right? So you can grow peas 1 in every 3 years. For chickpeas, that window is even longer, so at 1 in every 4 years. And that has to do in large part with some agronomic concerns, especially related to crop diseases. So the disease pressure is generally larger and more intense the more frequently we grow these things. So it might be attractive, right, given incredibly high prices for chickpeas, to grow as many chickpeas as you can. However, your expected yield is going to drop off pretty sharply if you start to include these things in rotation more frequently than is optimal. And you're going to restrict your ability to purchase production and revenue insurance. And given what we've seen with the drought in this last year, having some form of production insurance can be very, very beneficial to the grower. Okay, so to summarize, pulse crops have some unique aspects. We have a unique relationship between the US and global markets. We're particularly reliant on a few markets, especially that Indian market as a major source of US pulse exports. Marketing contracts and the way that pulse crops are purchased are slightly different. A lot of this is grown under forward contracts that have some unique provisions, and the cash markets can be a little bit more variable and a little bit more opaque than cash markets for wheat. That said, and the other thing, as I just mentioned, was there are some agronomic and insurance constraints on how often they can be included in a crop rotation. So even if we'd love to grow pulses every year, we've got to grow these things in rotation with cereal crops like wheat. That said, pulse crops retain some of the fundamental features of other commodity markets. Prices are variable. There's a seasonality in prices. We often see a price low right around harvest time. Cash prices are lowest when growers are taking that crop off and there's a lot of crop in the country. And they respond to supply and demand information from around the world. So we grow these things in a competitive market. We're not the only ones in the world growing these pulse crops, and so we're subject to supply and demand conditions on a global level. So how do we think about including pulse crops in rotation? We looked at prices, and we might just think, well, when pulse crop prices are high relative to wheat prices, it makes sense to include a lot of them in rotation. And that's sort of what's been happening, what's been driving that increase in acreage that we've seen across time. So this is just the ratio of the per bushel price of peas relative to the per bushel price of wheat. And in this graph, we can see that back in the 2006 to 2010 period, where we had even with relatively high wheat prices, we're still in this range where say pea prices were relatively equal to wheat prices on a per bushel basis. So this was slightly below 1 most of the time for spring wheat, slightly above 1 for winter wheat over most of this period. But then over the last 7 or 8 years or so, we've seen a tremendous increase in pulse crop prices relative to wheat. And that's driven people to adopt these crops. And we were at a pea to wheat ratio of nearly 2 back in 2015 and even into 2016, especially for winter wheat, when prices were relatively low for winter wheat in 2016. Peas looked like a really good option. That's fallen off a lot, especially as we saw a spring wheat rally. But in historic terms, the pea to winter wheat ratio is still relatively high. It makes pulses look really good. If we did the same exercise for lentils or chickpeas, I think we'd see that pulses look really attractive. That said, we can't just think about prices. There are a whole host of other things that matter. So we got to factor in all of the economic factors that affect the relative profitability of these two crops. Some of those things that we're going to talk about are water availability, right? So, and the main crop rotations that we're going to compare here are wheat fallow rotations and continuous cropping rotations that include both wheat and pulses. So one of the major factors to think about here is water availability. And when we're in a wheat fallow rotation, we may be able to conserve water that's not used by that pulse crop relative to a recrop or a continuous cropping situation. How is that going to affect the relative profitability of wheat and particularly wheat fallow relative to a wheat pulse kind of rotation? Including pulses in rotation is going to change our input costs, and especially fertilizer cost is going to be one of the things that we're considering, right? So One of the key benefits of pulse crops and rotation is that they fix their own nitrogen, they're legume crops. And so our fertilizer requirements for pulse crops are substantially lower than for non-legume crops like wheat. It's going to affect our machinery needs, and thus the machinery costs, the costs that we can attribute to our machinery usage in a given year. We'll talk about how to estimate those. There's going to be some benefits and costs in terms of operator time and effort. So one of the benefits of pulse crops, right, is that we're not necessarily planting or harvesting them at the same time as wheat, so we can spread out our time and effort across a wider window. That's a benefit, but at the same time, there's a cost to growing more crops, so doing different things, and taking the time and effort to learn how to grow these pulse crops effectively. Finally, we're going to spend a little bit of time thinking about diversification and risk. So we know that pulse crop yields can be highly variable, but at the same time, they give us some opportunity for diversification. So not all of our eggs are in that wheat basket. When wheat returns are low, we might still get pretty good returns from pulse crops, and that can help sort of offset some of the risk of any one crop in our rotation. The tool that we're going to use are enterprise budgets. We need to weigh the relative influence of each of these and other factors in setting up a pulse crop rotation. Carrie, I'm just taking another brief break. Thanks. So if you're thinking about estimating the profitability of different crops, you might go, say, to your accountant, your lender, your local extension agent, particularly if you're thinking about adopting new crops, right? Crops you haven't grown before, you have no historical information, you might sort of need to get some estimate of profitability. And so one source that we're going to be relying on are crop budgets that are produced by North Dakota State University Extension. Unfortunately, we have no sort of Montana specific profitability estimates. But I'll talk about how to adapt some of these existing tools to your specific context. So if you were to go out and look at which crops are most profitable, you might look at these crop budgets produced by NDSU Extension and see that their projected returns for 2017 were highest, we see at the top of this graph here, for lentils, mustard, and chickpeas in northwest North Dakota. So those looked like by far the most profitable crops. They had the highest returns above direct costs. And I'll talk about what those direct costs are, what costs were included. When we're thinking about profitability, right, as revenue minus costs, which costs are included in this calculation. But those crops looked the most profitable, and wheat really kind of looked like a dog, right? So profits here for wheat were much lower. We want to think about what went into these estimates, what was excluded, and how can we adapt these estimates to a particular context. That is, the specific revenues and costs that you expect to incur on your farm. So before we go through that, it's sort of useful to define some terms. So when I'm talking about an enterprise, I'm talking about a specific product produced by the farm. This could be, for example, wheat, peas. It could be some of the livestock, if that's a part of your operation. So if you have a dairy, milk, if you have a cow-calf operation, those feeder cattle. Most farms consist of several enterprises, but we're going to just refer to as an enterprise any one of these specific products. So each of these crops listed in this crop budget is going to be one of those enterprises. And an enterprise budget analysis just compares those enterprises in which where some or all of the farm's projected revenues and costs are allocated to each of those enterprises. Okay, And so this graph is a form of enterprise budget analysis in that we're comparing the returns above some set of our costs for these different crops. We want to think about, well, how do we go about engaging in those calculations? How do we do those calculations? And then how does crop rotation maybe affect or change the way in which we should do those calculations? Okay, so some key concepts for enterprise budgets are, well, we're going to focus on two different categories of costs, what we're going to call direct and indirect costs, and I want you to understand why those categories matter. We're going to think about what costs should be included in the budget. Ideally, right, all of our costs get included because they're all expenses that are incurred in the production, and all of them should be included in this enterprise budget analysis. But some of these costs are difficult to measure, and some of them are difficult to associate with a specific enterprise. And then finally, how can we modify these existing available budget tools that are publicly available? These provide a starting point, but if they're not adapted to your specific situation, they're not going to help you make good decisions about particular crop rotations that you might want to adopt on your own operation. So it's important to note that these enterprise budgets are a profit projection. It's useful to understand that they're a snapshot at a particular point in time at which we estimate what profits might be. So these, for example, in these North Dakota state crop budgets, they are published every spring, and they're an estimate of production over the coming year. So in 2017, in the spring of 2017, they publish an estimate of what the 2017 crop will profitability looks like. But obviously we don't know, right? Some of the revenue and cost items that go into that budget are known with relative certainty. We know sort of how much we're going to spend on seed or herbicide for a particular crop, but we don't know, right, what's the price going to be when I go to deliver this crop after harvest? What yields am I going to get? And some of those cost items too might be subject to some level of variability or risk. The important thing to note is that when we're going through this budget exercise, we want to estimate revenues and costs on the basis of what outcomes are most likely. So we're going to use, for example, a yield estimate that's the most probable, most likely to occur value for our per acre yield. We're not thinking about, so in some agronomic exercises, it's useful to have a target yield or a goal yield in mind and trying to hit that target, right? Optimize our input use so that we can achieve maximum yield. But we know that production is subject to weather risk, right? The weather happens. And so it's not necessarily most likely that we're going to achieve that target level of yield. We want to estimate all of these revenues and costs on the basis of what's most likely. And that's going to give us sort of the best projection of what the profitability of these crops are. Sure, we might hit a home run in terms of yields, and that might make a particular crop look really good in our sort of crop budgeting comparison, right? But ultimately, to make these budgets comparable across crops, we need to go with the most likely scenario. So this is a budget summary for, I just chose 4 specific crops from these North Dakota crop budgets. And I want to just sort of walk through what's included in their budgets. There's a lot of useful information here, a lot of numbers and figures for these 4 crops. And we think about what goes into these North Dakota state estimates, and that'll help us sort of think about how we might want to adjust these estimates. So we need first some projection of revenues, right? That revenue projection is just going to be our yield multiplied by the per bushel or the per pound price. So we have a per bushel yield estimate and a best guess about what price is going to prevail in the fall. Now, obviously, right, this per bushel price estimate was a lot lower than prices that ended up prevailing. We saw hard red spring wheat prices that were much higher than $4.93 a bushel, but that was our best guess, the most likely outcome if we were thinking about this in the spring of 2017. So that gives us a per acre revenue projection, and we have per acre revenue projections for multiple crops, right? I've just included 4 here. More information is available, and you might want to look at revenue and cost projections for more than just these 4 crops. I've also included a column here for fallow, and the important thing to note with fallow, right, is that there's no revenue, right? In a given year, we're just going to incur costs, and that's going to change, and that's going to really affect our estimate of rotation profitability. North Dakota State classifies costs into 2 categories: direct costs, and that's all the cost items that are included here. So seed, herbicides, fungicides, fertilizer, crop insurance, any fuel expenses, repairs to machinery, and other equipment, some miscellaneous costs that you can go in and think about. You go and look at what they include in those, and then also an operating interest expense. So right, so the fact that most growers are going to be paying for these direct costs out of an operating loan, and so the interest is due on that loan. Those are the things that get included in direct costs. Indirect costs are some overhead expenses, just sort of general costs of operating the farm, costs related to machinery, and then a land charge. That's either sort of the cost of renting ground, or a cost associated with owned land. And I'll talk about how that gets figured. To calculate our returns, right, North Dakota State takes revenue, subtracts direct costs, subtracts indirect costs, and gets an estimate of what's called the return to labor and management. So we notice that one item that's not included in these budgets is any money spent on labor, and any return that's allocated to the farm manager or the farm operator. And so given that, for example, for spring wheat, North Dakota State was projecting negative returns to labor and management. That is, that there'd be no money left over after all these expenses were paid for paying for the labor that the farm operator incurred, or giving them some return to their management ability. So that made spring wheat look relatively poor relative to some of these other crops. So for yellow peas, the return to labor and management was smaller, but still negative. The return to lentils looked really strong, right? If we could get decent yields and at sort of even a relatively reasonable price expectation, sort of looking at these 2 numbers, we had significantly higher revenue. And even though the costs of producing lentils were slightly higher, our end of the day net returns were going to be much higher for lentils relative to alternative crops. Now, so the devil's sort of in the details. How did they get to these numbers? Well, we need to understand some key concepts, right? What's the difference between direct and indirect costs? So direct costs are going to be those costs that are necessary to produce a specific crop and are easily associated with that production. So obviously, our seed cost for wheat is the money that we spent on wheat seed and not the money that we spent on lentil seed. And it's pretty easy to allocate those costs on so take our total amount of money that we spent on wheat seed, divide that by our number of wheat acres, and get an estimate of the direct per acre costs of growing wheat. Those indirect costs are much harder to allocate to specific enterprises. So with things like land, machinery, and operator labor, it's hard to say, well, that combine, how much of the combine, the money that we spent, say, purchasing and using that combine, how much of it was for the wheat enterprise relative to the lentil enterprise? Operator labor, similarly, right? If the operator takes a wage from the farm, right, how much of their labor was used on one crop versus another? Allocating that to that specific enterprise and thinking about it on a per acre basis is considerably more difficult. The other thing that we need to think about here are that some of these costs are not necessarily directly observable, recordable expenses in the farm's accounting statements. So especially if we're thinking of if we're doing our accounting on a cash basis, right, when we only record expenses when we have some outlay of cash, some of these expenses are easy to recognize. Some of these are what I'm going to call non-cash expenses. And those expenses include depreciation and interest expenses on owned assets. So for example, right, how much of our machinery did we use up this year? What was the cost of using our combine? Well, it's essentially how much of its value we used up in a given year. That depreciation expense isn't necessarily a dollar amount that the farmer pays out of pocket to use that combine, right? It's a non-cash expense. Some of the costs related to owned land, right? So if you own your own land, right, there's no payment that you make every year to use it. But there is the capital, right, the money that you have tied up in that land, and that's a real cost. And it shouldn't matter, right, whether that land is owned or leased. We still have capital tied up in owned land that's similar to the rent that we pay potentially on borrowed land. And so we don't want to sort of make one enterprise look better than another because we grew that crop on owned or rented land. So in these budgets, we're going to include the same land charge. That's an estimate of this non-cash land expense for each crop. And then finally, right, the operator labor and management costs. So what an operator might pay themselves, what you pay yourselves out of what's left over after deducting all the other costs that the farm incurs, might not be sort of the true cost of your labor and management, right? And so sometimes, so we can think of those as similar as a non-cash expense. Okay, just to sort of think about depreciation, and I want to focus on this because the machinery needs for pulse crops sometimes are different than for other crops. Cash machinery costs, how much we actually spend on machinery, can vary a lot from year to year. It doesn't necessarily measure the contribution to this year's crop of that machinery relative to future crops. So estimating depreciation, how much of the value of that machine we used up in a given year, is usually seen as a better estimate of the true machinery cost in any given period. So depreciation is really just the process of thinking about what's the current value of a machine. And I've sort of just plotted that as a given point here on this graph, right? We know that over time, so as we move along the x-axis here, right, the value of that machine is going to decline as we sort of use up the machine by running it for more hours. We get to some value at the end of its useful life. And we just want to think about, right, how much of that machine we use up in any given year. The simplest method is just to think about a straight line between the current value and the salvage value, and think of that in any given year, right? The change in that salvage, the change in that value in any given year as the depreciation cost for that machine, right? So the simple formula for this is just thinking about the current value minus the salvage value divided by the useful life. So what's essentially the average depreciation, average amount of depreciation over the whole useful life remaining on that machine. And that's going to give us a better estimate than, say, what we spend in terms of actual cash outlays on machinery in a given year, right? So, and this is particularly true, right, if we're investing in new equipment, adding new equipment used to grow, say, a new crop like a pea or a lentil, right? We don't want to say that all of that new equipment should be included in the cost of production in 1 year, right? We want to spread that out over the useful life of that machine. Okay. Key thing to note here is that failing to properly account for revenues and costs can distort our estimates of enterprise profitability. And we want to allocate revenues and costs to the correct production period, right? So if we have, say, fall applied fertilizer, we don't want to include that in the cost of producing last year's crop. It's really fertilizers that's going to be used up by this year's crop, and that cost should be included in our estimate of the cost of production in this year, in this coming year. This is key to this difference is the key difference between what's called cash and accrual accounting. Accrual accounting tries to allocate those revenues and costs into the production period for which they generate output. The other thing to note here is that those non-cash expenses are often economic, or what are called opportunity costs. There's something that can't be directly observed. They don't show up in our accounting statements, but they almost certainly aren't zero, right? So even if all our land and all our machinery is paid for, right, the cost of using it isn't zero, and we want to account for that, right? If we put more hours on our combine, right, there's a real cost to that in the sense that we're using up that combine. It's not going to be worth as much at the end of the year as it was at the beginning. Okay. So just thinking about how are these enterprise budgets developed, it's important to sort of identify different enterprises and the production units. In this case, the production units are generally always going to be acres, and we're going to estimate per acre revenue for each enterprise. That, I think, is pretty straightforward, right? We're going to think about revenue per acre as price times yield. We've got to determine what costs are associated with that enterprise, classify those costs as direct or indirect. We can go out and measure or estimate what those direct costs are. For the indirect costs, this is a little bit more difficult, right? So we know that, say, we're going to depreciate a combine by so much, by so many dollars in this given year. We can divide that by the total number of acres, right, and get a per acre estimate. But then how do we allocate that per acre estimate to particular crops? We can do this on a basis of use. So how many hours we use this machine, say, on one crop or another, and that can be pretty helpful. But there are alternative methods. Sometimes it's appropriate to allocate a machinery cost solely to one enterprise because we have a machine. Say if we're using a land roller in the production of lentils, where we want to get that, and we're not going to roll our wheat ground, right? We want to allocate that cost, that essentially an indirect cost. It's not sort of, that indirect cost looks a lot more like a direct cost. Allocate that to a specific enterprise. And then finally, we're going to calculate that per acre profit, thinking about revenues minus all costs, both indirect and direct, that we've allocated to that enterprise. Okay, so a good starting point here is to use crop budgets that have been developed in as similar a context as the one that you're in, and start with that as an estimate. And then you, your accountant, your lender, your extension agent, and others can help provide useful information that adjusts those revenue and cost estimates to your specific situation. This is hugely important because costs can vary widely from one farm to another. And some of the decisions that you make about what machinery you're going to have on your farm, right? There are high cost and low cost ways of planting, protecting, and harvesting a given crop. So those cost estimates widely, and it's important to adapt those to as best as possible to your specific situation. So going back to our budget here, we can think about some of these some of these numbers might not be particularly well adapted to your specific situation, and others might be better adapted. So this yield number, right, is obviously going to be highly variable throughout our state, right? Getting a 38 per bushel spring wheat yield is not necessarily a given. In fact, it can be somewhat difficult in some parts of the state relative to others. So this is a number that we're going to want to adapt to our specific context. Some of these others might be particularly good estimates. And again, some of these things are probably known, say in the springtime when we're making planting decisions, right? Some of these are known relatively well, and others of these are going to be somewhat more guesswork. So this price estimate, what price are we going to get for this crop? We can look at what buyers are willing to pay us in that forward contracting market, but we don't know the end of the day price that's going to prevail. Okay, so as a starting point, then how do we take an estimate, just sort of thinking about, okay, we've got some estimate of the relative returns to these different crops. How do we think about putting this now in a rotation context? So what we're going to do at the most basic level is just weight those returns by the proportion of our total acres we want to allocate to each enterprise. That's going to give us a per acre estimate of the returns from that rotation. So we can compare, for example, a spring wheat fallow rotation to a more diverse crop rotation that includes both cereals and pulses. So the two rotations that I'm going to look at here are the spring wheat fallow rotation, where we allocate essentially 50% of our acres to each crop, to each of spring wheat and fallow, and a spring wheat pea winter wheat lentil rotation, where we allocate a quarter of our acres to each of those crops. You can adapt this to your situation, right, by just calculating or determining the percentage of your acres that you're going to allocate to any one of these enterprises and using those as the weights in calculating your net return. So if we're thinking about the return to direct cost calculation, we can simply take the estimate of the returns over those direct costs for each crop and multiply them by the proportion of acres allocated to that. So in that 50-50 spring wheat fallow rotation, we multiply 0.5 or 50% by the return over direct cost for spring wheat, and then add that to the weighted return for that fallow enterprise. So in this situation, I've assumed there's a slight negative return from fallow production. If we're chem fallowing that ground, we have to have a herbicide expense for that fallow year. We can look and think that our returns over direct costs are going to be the weighted sum of those two returns from each of the crops. That gets us an estimate of the return over direct cost for the rotation of, in this case, $18.91 per acre. We can do the same thing for the continuous cropping rotation. Multiply 0.25, right, the proportion of acres, by the return over direct costs. And in this case, notice we've used the same estimate of spring wheat returns and add that to the weighted return over direct costs from the other enterprises. So the pea enterprise, right, had higher returns. The winter wheat enterprise had lower returns. The lentil enterprise, obviously, right, had the highest returns. And that's driving this estimate here of the returns over direct costs for this rotation to be significantly higher, right? So yes, we can grow lentils, but we can only grow them so often. So our returns per acre aren't going to be exactly the returns per acre from lentil production. They're going to be a weighted sum of all the crops that we include in our rotation. In this case, that continuous crop rotation is exhibits significantly higher profits. There's a significant drag to fallow if we don't adjust these crop budgets in any other way. Obviously, now we want to start to think about how can we adjust those enterprise budget estimates of profitability for some of the things that we know about differences in crop rotation across rotations. So one of the things is that in those NDSU budgets, they assume that we're always in a recrop situation, that we're in a continuous cropping system. And we might think that a wheat fallow rotation does have some significant benefits. Higher yields are possible because of greater water availability, because we didn't plant a crop in the last year and we didn't use up soil moisture. What we could think about is, well, what does that do? It gives a yield boost to that that spring wheat crop that's grown on fallow, right? Suppose that yield boost is 15%. What does that do to the returns from that spring wheat fallow rotation? Well, it's going to increase our returns over direct costs by from about $53 an acre to $81 an acre, right? That significant yield bump doesn't do anything to our costs, really, doesn't do much to the price that we receive, but it does give us a significant yield bump. And that makes that spring wheat fallow rotation look better. Not as good in this case as the continuous cropping rotation, but that might depend on the yield boost that you assume, right? And your estimate of your returns for a spring wheat fallow rotation relative to a continuous cropping rotation. Okay. So if we think about that just in this context now, right, what we've done is just adjusted our yield estimate up here, made that 50, if we make that 15% higher, it's going to increase our revenue and increase our estimate of the returns over direct costs. Okay. Moving from a spring wheat fallow rotation to a continuous crop rotation can allow for more efficient machinery usage by spreading some of those fixed costs of machinery for a given machine over more acres. So in those NDSU crop budgets, right, assuming that we're in what they do is they assume that we're using some subset of our machinery for every crop in every year. So for example, our combine can be used on both our spring wheat and our pulse acres. We can use it over a longer harvest period, cover more acres, and reduce the per acre depreciation cost that's associated with a particular enterprise relative to that spring fallow period, right? So if we go back to sometimes, right, moving from a wheat fallow rotation to a continuous crop rotation can do the opposite. It can generate some new costs for specialized equipment needed for pulse crop production. So one example that I talked about already was potentially rolling the land to allow us to more easily pick up those low-hanging pods for those pulses. We might also think about investing in a flex header. So there's some crop-specific equipment. These should be allocated only to a specific enterprise. And so there's sort of a trade-off there, right? The given budgets that are produced by NDSU assumes a recrop situation. And it assumes, for example, that the combine depreciation expense is the same for every wheat acre as it is for every pea or lentil acre. If we think about these machinery expenses in a wheat fallow rotation, right, now we still have the same set of machinery, but we don't get to use it on those fallow acres. So what do? Well, one idea would be to potentially double our machinery expense for wheat. We could include those same indirect costs for fallow. That is, right, if we're thinking about allocating an acre to fallow versus lentils, we still have that same cost of some of those machines. This is going to make wheat fallow rotations look a lot less profitable, right? And so in general, if we're looking at this budget, one thing to note is that in here, if we're thinking about those indirect costs, right, it's almost certainly not the case that the depreciation and investment costs for that machinery are zero. it's probably more likely that they're pretty similar to the machinery and investment costs for wheat, because we still have all of that equipment, but now we're spreading those costs across fewer acres. And in large part, that's driven a lot of the switch that we've seen from wheat fallow rotations to continuous cropping rotations. So long as you can swing it in terms of not decreasing yields because you're sort of moisture constrained, you can spread some of these machinery and investment costs and the cost of land, right, over essentially over more acres, that you are generating more revenue from the same expenses. The last thing to think about is that these given budgets assume fertilizer use is considerably lower for pulse crops. So if we go back to this budget, we can see that fertilizer expense for spring wheat was estimated about $43 to $51 an acre, significantly lower for yellow peas because we're not applying a whole lot of nitrogen on those pea or lentil acres. That said, there might be even larger benefits, and so agronomists have talked a lot about whether in a continuous crop rotation, we can lower our fertilizer cost for non-pulse crops because there's additional nitrogen left in the soil after we harvest that pulse crop. Nitrogen that wasn't produced and used up by that pea, lentil, or chickpea crop. Most budgets that I've seen don't incorporate a nitrogen credit, but what that's essentially going to do is lower that fertilizer cost for those non-pulse crops, and it's going to improve the profitability of continuous crop rotations. And so in your particular context, you might want to think about doing some soil testing and thinking about how much nitrogen is left by that pulse crop that's used in that rotation. The last thing that we want to think about as we adjust these budgets is to think about variability and risk. So crop budgets are looking at sort of that most likely scenario, and your actual experience won't match your budget projection. There's just no way that that's true, right? Given when you make that decision in the spring, you need some projection because you don't have anything else. You don't know what's going to happen with certainty. But that said, different crops might have different risk profiles. So pulse crop yields are likely more variable, especially for new producers, and that might make pulses not look as attractive relative to other crops. It's important to conduct some what-if analysis. Change your estimated prices, yields, and costs, and see how the returns to different rotations are affected by those changes. If you have a really bad year, if you have that yield catastrophe event, how do those rotations look in terms of their returns for that wheat fallow rotation relative to the continuous crop rotation? The other thing to remember is that diversification has some risk reducing value. It's hard to put a dollar amount on that. So if we think about going back to our budgets, our budget estimates, right? These are the returns to labor and management, but we know that we can't put all of our eggs into that lentil basket, even though it looks like by far the best option in these crop budgets that are estimated, in these crop budget estimates, right? It's not necessarily going to be the case that lentils are always better than spring wheat. And so growing these two things together conveys an additional benefit, right? That if spring wheat returns are low, lentil returns might be high, and vice versa. If we have a bad event with lentils, at least the spring wheat might pull us through. So in summary, right, I think it's really important as we're thinking about what are the relative returns of sort of traditional wheat fallow type rotations and other rotations that include a continuous cropping situation, it's important to incorporate our best estimate of the relative profitability of the crops that we include in those rotations. And we need to the extent that you possibly can, adapt those estimates to suit your own particular situation. if you're estimating a basic budget, do so based on the most likely rather than the best case scenario, right? Lentils look really good at average or above average yields, but in a disaster scenario, they do incur higher costs and may look significantly worse than cereal crops. Different rotations are going to require different adjustments to the enterprise budget. So, for example, right, spring wheat returns change based on whether we're in a fallow scenario or a recrop scenario, right? Those spring wheat returns change for each rotation, and so it's important to develop enterprise-specific estimates of returns under each rotation scenario. Finally, incorporating risk is somewhat difficult, right? To think about, say, what's the benefit of being more diversified? Hard to put a dollar per acre number on that, but it's useful to think about, especially given that we generally want to reduce risk rather than increase risk. So with that, I'll stop. I've provided my contact information. If you have any other questions about pulse crop marketing, pulse crop economics, or the economics of including pulse crops in rotation, I'm happy to answer those questions. My email address, website, phone number, and Twitter account are provided. Feel free to contact me. Thank you for your time and attention. I hope you found the webinar useful. Thanks.